Good afternoon and happy Saturday. I hope you all had a wonderful week, and I hope everybody is doing well, getting ready for spring in a month or so. So, um, as always, we will review. Obviously, everything is really we're almost toward the end of the earnings, which are not completely done. We will discuss that. But it's all about economy, right? Last week we had inflation numbers regarding the consumer price index, regarding to the producer price index, and it's all about Fed and all the central banks around the world. So basically, we will discuss that, what is upcoming next week, the markets, obviously, the emerging markets, few lessons of the week, trade of the week, and screen of the week. So there's few things happened last week, so I'm just going to summarize. We will go in depth as far as the CPI and PPI, what has happened and what happened last week, and why we still, why the market's still paying attention, and of course the Fed's reaction, what it would be. And another thing you could see in the Friday, it was a pretty bumpy, in a sense, nothing much happened, but it was volatile. Well, it was option expiration Friday, so that's with that, and also the President's Day coming up, as you know, the settlement, what has happened now, the rolls, it's going to happen on Tuesday. So there was a lot of choppiness in that. And one thing we have noticed, as you know, we have these daily options on S&P now, and it's going crazy. The volume has expanded quite a bit. So what is happening, that's why you have to pay attention to the gamma squeeze. It used to, we have to wait for, when there used to be 3 times a week, originally it was weekly, it was a little easier to absorb. Now that it's every day, unfortunately, some of the investors who are not really in the business of trading, they are taking advantage of this in a way that they think it's almost like gambling. So there is quite a bit of, as far as the options volume, when you think about SPY, it was about 9 million just on Friday, and SPX was 2.5 million. And SPX is 10 times SPY, and then we had obviously options on the futures on ES. So this has made the things really volatile. So you don't really have to be the futures trader now. People who do option trading, they are basically using the same volatility. So those are, I just want to get it out of the way. It is important to pay attention to these option activities. As far as economy, we go under the hood. As you can see, still the employment, as far as the continuous jobless claims and initial jobless claims, you're doing better than 2019. The staffing index is again ahead of 2019. And these commercial flights are back. I was listening to the JetBlue's CEO. Now in summer they're going to have flights to Paris, and they're very optimistic. So people are coming back, and they're paying the fares. People are notice like Airbnb surprise the market, so people are traveling. They will travel as long as they can. The only thing I will give a warning is we have to pay attention to is the consumer. Obviously, the consumer spending is very important. The retail numbers came last week. That will cut everyone in a sense by surprise, although it has to be seasonally adjusted. But it looks like, with all the monetary and fiscal easiness of the COVID related, Americans especially running out of savings. So I would watch, and I've talked about this, watch the credit cards. And that's what I pay attention to, the banks, to see how far they're going to be using their credit cards and what will happen. I mean, the employment, at least on surface, it looks strong, it looks good. But if you have a double whammy with a high debt on the credit card and a slowdown in employment and inflation still being there, these are the factors we have to pay attention to. So what was last week? Again, the big thing was on Valentine's Day on Tuesday, it was the CPI and core CPI, and it came at 0.5% month over month, which was as expected. The core CPI was 0.4 and 0.4. We will discuss it a little more. Then we had the retail sales, which came stronger than expected. And then what we had the PPI, and PPI was the, so we have the consumer side, now we have the producer side, and they actually surprised the markets. They were hotter than expected. They came at 0.7% versus the 0.4%. And the core PPI, which again excludes the more volatile aspects of the index, which is the energy and food, still came higher than expected. So that's the thing, if you notice how the market reacted negatively to that. And then basically those were the really big ones. On top of that, we had, as soon as this PPI number came, and after the CPI, the retail sales come, and then we have a couple of the hawkish Fed members, which Mercer from Cleveland and Bullard, they all are looking at, the expectation is 0.25% of increase in March 22nd, I believe, the meeting. They're looking at 50 basis points. So with that in mind, what I would recommend is, Wednesday, February 22nd, we have the meeting minutes. So we want to pay attention, which is at 11, again, Pacific Coast time. So that's something I would encourage you to pay attention. As you know, Monday is holiday in the United States, but the futures market will open Sunday evening, and then they will close at 10 a.m. Bond market will be closed, but if you want to trade futures, let's say S&P, but the volume will be low. I mean, I would encourage you just enjoy your day. But New York Stock Exchange and all the exchanges, they are closed. So that's for Monday. So that's why this Wednesday number, information is important. We also have the preliminary GDP quarter over quarter. We want to pay attention to that. And then we also on Friday, this is the another level of the inflation that really Fed pays attention. So we want to pay attention to that. So what happened with CPI? So CPI came on, as I said, came on Tuesday, and it was up 0.5% in January, but year over year. So remember the 12 months, now we're dropping January, we're adding this January. So it was expected to be 6.2%. It came at 6.4%. One of the culprits for that month of January over December was the energy prices, with the natural gas and the heating oil. It was up actually 2%. Housing rents will continue. They are continuing really surprise the markets in a sense that although it has softened, but these are really just the new ones, so the renewals haven't shown up. So we don't know how much increase that would be. And they're still up, consider they've been just up 0.7%. Now the core CPI, as I mentioned, they were up 0.4%, but 12 months is at 5.6%. Again, this excludes food and energy. The housing rents, as I mentioned, again, I put it twice because we look at CPI, but it is a big chunk of the core CPI. Again, we take the energy and food out. So again, they were up 0.7%. On the other hand, the airline fares that month, they were down 2.1%. Used vehicles were down 1.9%, and medical care services down 0.7%. So when we look at this more in a chart, on the 12 months, you can see how food has been the biggest culprit, and this energy, and then the all items, as we talked about, was 6.4%. This is more reference. Again, you can see the food has been 10.1% of basically increase at 12 months, January to January, 12 months. And what I mean by that's 12 months from January that we dropped the 2022. Now we're adding 2023. As you can see, the cereal and baker products are a big culprit, and the energy, you can see that the fuel oil has been up 27.7%. We will discuss it a little more in the lesson of the week. So this is just, again, as a reference. I just want you to when you have a free time, you can look at it, what's happening, and you see this natural gas was up 26.7%. I want to go back. I went to the 1991 and was looking at the basket, which we use based on the CPI. This is adjusted seasonality for the consumer price index. And I used 20-day moving average, or actually this is on monthly, sorry, a 20-month and then 50. And you see how we have been. And you see the slope. I mean, this has been a fast moving, and where we are, and that's why we are, paying attention to what's going on, how fast we have moved. So just a food for thought, comparing to, let's say where we were in 2007, 2009, and then during the COVID. So just thought to have something in that effect. And then, of course, then we have Thursdays, we get the producers price index, which comes from the producers, and they really surprised that they rose actually 0.7% in January. So and they were all basically virtually all across the board, there was an increase. So although when we look back and we're looking at this, so it looks like we actually have peaked in inflation and it's behind us, but there's that pace that it is still the Fed. I don't think they are that flexible, that people are thinking even reduction by end of the year. I think this is still in their plate. And as I mentioned, there is I think the idea is there might be 2 rate increases, but now I think the markets are looking at the 3rd rate increase, and some of them, as I mentioned, at least 2 of them that I know, they want a 50 basis point. There is about it was like 5 or 6% last week before this PPI. I believe it's like 11-12% chance that we might have a 50 basis point. So as I mentioned, we're looking at it again. This is from the PPI point of view. Energy rose actually 1.2%, and as far as again, we talked about the whole thing actually 1.2%, but energy prices increased 5%, and I just showed you like a natural gas, diesel, and jet fuel all rose, but the food declined 1% on the back of softening prices for vegetables. Removing these typically volatile, like I mentioned, food and energy, so we go to the core, they rose 0.5%, and it is up, as I mentioned, 5.4%, which is obviously it's much higher than the Fed's target. Going back to the interest rates, and again, we still have that almost 80 basis point spread. So the chances of we're looking at the recession, it's still that, the history tells us the possibilities are very much there. And I mentioned last week, the leading economic indicators, the LEI, it's still showing that we will have. And if you talk to some of the small business owners, the thought is, by 4th quarter, the risk is there. And I will discuss more. Last week I talked about the CPI, the inflation, and how the maneuvering is happening, how we had last year, for instance, this time, when you think about February, I believe next week, this unfortunately, it's already a year anniversary of invasion of Ukraine by Russia, and what happened to the commodity prices from food to energy. Now, next month when we have the CPI, this February will be dropped. That number of it happened. In the meantime, consumers are flexible, so some of them stopped maybe buying gas. So remember, the CPI is a consumer price index that it looks at their behavior on what they spend on. It's not like they say the price of gas went up, it's the spending of the consumer. So basically with that, the inflation numbers might not be really reflective of what is happening with the economy. And the employment numbers, I mean, as it is strong, there's still, when you look at different industries, some of them, they already have a slowdown. So it's not really universal when we look at things. So you got to be selective. So this thing still is a warning sign that the flattening, I mean, from the inverted yield curve. I want to go back and I want to look at, again, this is our 10-year yield, and done the Fibonacci from 1980. As you can see, had the resistance, and you look at the 23.65 number, you see we hit that, and then we corrected. But the way I look at it, if you look at all these, it's almost like a pole of bull flags. So we've had one here, we had a bear flag here, and then we continued, and we obviously we basically stabilized, and then we have these bull flags. Now, does that mean that interest rates will still continue, especially on the 10-year? So again, the month of February is not over, but we will evaluate from the market's point of view. Now, last week, as far as the sentiment goes, the AAII, I mentioned to you, it's the first time in a long time, we actually had a positive 12.5% to the bulls. This week, we kind of gone back a little bit. We're still in the positive. We are up about 5 or 5.3 separation, but the bulls are still ahead of the bears, and they think that we will be ahead 6 months from now. But relative speaking, we're still below the average now. And then the bears are also below the average. So there's this little indecision. And actually, the charts will show us that there's a little indecision. On the other hand, the CNN fear and greed with the 7 components, they are exactly where they were last week. We were at 69. Today, we're at 69. So it still shows that there is optimism going on. So what kind of week we had? Last week, I said it was important. Markets were waiting for the CPI numbers. And basically, we didn't really get a lot of clarity. There was a lot of, fluctuations, a lot of intraday volatilities. But as you can see, the Dow was pretty flat, 0.13%. S&P was 0.27%, and NASDAQ was up 0.59%. So really, we haven't gotten conclusive evidence which way we will go. So I would not short this market at this time. I would not go long. So I think we need some kind of a clarity, and we will see in the charts. I mean, look at this, the whole, look at total stock market was completely flat. It was up 0.04. And when you look at the large caps, you can see how there was not much movement. But then when you get to the mid cap, which we discussed last week, but that's the small cap, look at the small growth. There's a lot of action there, the small caps. So basically the markets right now, they are in a neutral zone, but I think the charts will help us to see what should be our next action. So I'm gonna work got a few charts on the S&P, so I want to look at it from different angles. So I want you to keep your notes handy if you want, just the numbers that we are in. Now, this is more of a short-term Fibonacci, basically from the high of the summer to the low of the October. And as you can see, these Fibonacci's, I mean, they work very nicely. We had a double top. We had a round number. If you recall, I had a trade that I shorted right around here, but I stopped out. So, but anyway, it is providing resistance at this junction. And since then, we are basically kind of fluctuating now. Where we are we broke below the 8 and we are right under the 21. So 21-day moving average, but we are right on top of 61.8. So keep that number. So this zone, I mean, we can go either way. So what we have to look at is, now, if we break that 50-day moving average, then, we are going to be in the ambush zone, and the next obviously stop will be the 50% retracement. But if we break above, and that 4,200 is important, and I've talked about that zone, the 4210 area, 4205. And if we break, I mean, we can easily go to 4,300. So basically, this doesn't give us complete conclusion of where we are. We just know we are in a kind of a trading range zone right now. So the other thing I want to look at from the classic point of view, and you will see this, it happened in NASDAQ and Russell. So the way I see it from the beginning of the year, what we are seeing is a bull flag. This is our pole. And you can see we have retraced right to the low end of our trend line. So we found support there, and we got the bull flag. Now we are resting right there. So this zone is important. This is on SPY, which is ETF or S&P. So again, we want to pay attention to that. So I cannot, just because we've been going down, that doesn't mean this is the time to short the market. So I would be a little careful in having major biases. We need clarity. Now, given that, I mean, if you break through this, and this actually could be a wedge, you can see this could be actually a wedge, and we break down, then yes, you can short the market. Or if you break up, then you look at this pole, I mean, we could have a nice run up. So just make sure you take your emotions out of your judgment. I want to go one step further. I want to go back to the highs that we had in the beginning of last year when the S&P hit its highs, and using the Fibonacci from there to October lows. And where did we go? That 4,200 zone again, the area was our 50% retracement, which is very strong resistance. So we've been floating around between 38.2% and 50%. So as I mentioned, now you can see in many ways, if we break this in many levels, it is an important resistance. But we do have these resistances. That's what the market is respecting that. And then we have this support. Looks like, double tops. We can look at basically we are kind of broken above that trend line a little bit, but it is something that you want to pay attention. Again, you see we keep coming back to the resistance, but also there's support. When we look at from the linear regression channel and we look at the squeeze, so granted we lost the momentum here when we look at the squeeze side, but we still have the A wave and the C wave on a positive, and you see that slope still positive. This was very important. This is a doji right under or close to the 21-day moving average. So we still right on it, and right on one standard deviation, -1 standard deviation on LRC. So the slope is up, but again, there's an indecision. So as I mentioned, it looks like an bull flag, but it is a market that we'll have to pay attention. Again, the next week, we'll see what the minutes are telling us, what is the market as far as the Fed members, what they have to say. So that's something you're going to pay attention to. So as far as we're looking at the Bollinger Bands, we see now we are getting narrowed. Basically, nothing really has happened in almost 3 weeks, and we shall see that we are running out of momentum because the stochastics is pointing down. Remember, the MACD got really flat, so MACD is pointing down, CCI is pointing down. So we have lost the momentum at this moment, But as I mentioned, we still don't have complete in a way of saying that we have, you know, a clear sell signal at this time. So we'll be more cautious on that. Another resistance you see is on the S&P now on a 100 weekly moving average. Again, that 40, it's a 4,213 area is, and the Bollinger Band. So on a weekly basis, they have given us resistance. So, but we are above the 18-week moving average. Our stochastics, they just went to overbought very, very marginally. MACD still up, and the CCI hasn't crossed the moving average. It's a little overbought. But again, this just tells us that the boundaries. On NASDAQ on a daily basis, again, similar to S&P, we are right on that 18-day moving average. Although, again, our stochastics pointing down, momentum is down, MACD is flattening and they're pointing down, and CCI. So momentum we have lost. The question is, as I mentioned, I need confirmation that we have lost this. So basically, if we get it, then we are good to go. On the other hand, you see the Russell very nicely just hugging that 18-day moving average. The momentum still on the stochastic, we are above 50. So the momentum is neutral and it could actually turn positive. MACD is flat and we did cross it, and CCI is pointing down. But as I mentioned, I don't have the momentum and all of these. I've been tired because we had such a nice run, but that doesn't give me the conviction that, well, let's short this market this time. And look at this. This is the Dow. Dow was the hero last year, but look at this squeeze right here. I mean, the Bollinger Bands are really becoming bottleneck, and look at this. And basically it's been flat. I mean, you go back, you see the whole year, really choppy. Look at this MACD. What are they going to do with this MACD? So although CCI gave us like a sell signal here, but now we are oversold. So what this tells us now, I don't know how long this will take, but it will, we are above the 100-day moving average, and it just broke below the 18-day moving average, but this could coil. So we watch this to see which way it's going to be the direction. Now the transportation are kind of similar to the Russell. We are above the 18-day, and again, kind of similar to what is happening with the MACD, with all of those. The VIX, you see the volatility has also been narrowing, but we are above the 18-day. Now, this has been back and forth. You know, we did sell, but we are under the 100-day moving average. But as I mentioned last time, we want to pay attention to the VVIX. Last week, we went outside the Bollinger Band, and we mentioned that a lot of hedge fund managers probably paying higher premium to buy calls, for instance, on VIX. So maybe they're done, but we're still above the 18 and 100-day moving average on the VVIX. Now, this is what I would pay attention. This is the 10-year yield. So all the indications are, you know, Friday, we did have obviously got lower, little sell-off on the yield, but we are embedded on the stochastics. MACD is up, CCI is up, although there's a little divergence here. But you know, Bollinger Bands are opening. So does that mean that the yield could actually go up? Especially again, more Feds are coming out and being more hawkish. So pay attention to that. It's going to be an important week, I believe. And then you can see this is another pretty picture on the 10-year. And we got a little stability. We touched the Bollinger Band, and this is the time the shorts kind of cover. But there's a heavy resistance at 118-day. We are embedded on the downside. MACD is down, so we might have a little divergence here with the CCI. but I don't know if that's enough. So maybe we can look at the more of a shorter term. But so far, it is the markets are being hesitant because they were putting the whole idea was before that CPI number that they will have they were thinking by end of the year we will actually have rate cuts. I think they have resigned the idea that they probably won't have rate cuts. So there's been that back and forth. So I'm gonna pay attention to that. Now, since we are talking about this, I want to say something. We don't pay attention too much. We talk about just the rates, but the as you know, the quantitative tightening has happened, obviously in US and Europe, and you know the finally US, you know, which was buying all the bonds and notes. Now they first frozen and they're selling it. The thing we have to pay attention, we got to have a balancing act as well. So liquidity is the key. So obviously with the quantitative tightening, which is opposite of quantitative easing, the liquidity gets drained because now it's not the Fed is not buying, not only not, it's just being on the supply side rather than on demand side. But I want you pay attention to the China and their policy, and now with Japan, and obviously Japan's got their new head of their central bank, which was elected. So we don't know a lot what's going to happen, but between Japan and China, they have been actually easing big time. So what is happening is one side is Europe and United States, they're tightening, but we do have a counterparty in a sense that they are easing, and they are in a basically, especially China, they are on an accommodating policy. And that's why you don't want to go to the whole thing with the thing of that there is no liquidity at all. So let's balance it out. But anyway, right now the bonds are telling us that, you know, they at this time they don't think there is going to be a rate cut. And the other thing we have to pay attention is the dollar. So as you know, with the higher interest rates comes at the higher dollar, and now we are embedded. MACD is up, although again there's a little divergence on the CCI. It was getting a little overbought. So, but you know, although it has been down, it still haven't, you know, it's been pretty flat. So pay attention to the dollar as well. The dollar will be a good guidance for the markets, as you shall see in the lesson of the week. I hope you will pay attention to that. And you see opposite is in Euro. Euro is pretty flat now and embedded on the downside and the MACD. So it's interesting how, again, Euro being 57% of the dollar index. Gold, we talk about dollar and gold. You know, it has been not a pretty situation. Obviously, stronger dollar, higher rates affects the gold. But I've said it before, I think around January, end of January, I mentioned it lightened up in some gold holding. It's just a seasonality, in my opinion. So, you know, just pay attention to that. Like, I think seasonality plays a big role in choice of your assets, timing. So, but you see we are embedded, MACD is down, very flat on CCI. The same thing with silver, is even, this is weaker. We are just broke below the 100, again, embedded. We were doing really nicely, but see, we had this squeeze right here. And this was right toward end of January and beginning of February. Again, seasonality-wise, is the Chinese Lunar New Year, for instance. All of those go hand in hand, so pay attention to that. Copper, again, the China story. Now things are kind of settling. It's interesting that we're getting a little divergence here. So the stochastics is now the momentum. They went from oversold, now momentum is up. CCI is going up, but we have that 18-day moving average resistance. Bitcoin has been on fire. So it's, we had another, again, little squeeze here, and now it passed, hit that actually to 25 and basically 25,095 on Friday. So the momentum is up. Now we are overbought. So pay attention. We are overbought. And I believe, if I'm not mistaken, we are just hitting the 100-week moving average. So that that is important. So we might have some resistance at 25. 25 is a round number. So sorry about that. So pay attention to that as well. It's the Bitcoin. And of course, a lot of regulations and what's happening with now Binance has been coming up with their own story. So crude oil. But look at this. I mean, crude oil been back and forth. We've talked about between 72 and now it's just floating 72 and 80 and very flat. MACD is flat. And I mean, you see the moving averages are really flat. So we are floating between the Bollinger Bands, really. So until the OPEC comes out with the, they said they like to cut the supplies. So I don't know if the market really paid too much attention. You see, actually, the prices did go down, which helps the inflation, obviously. Now, natural gas, I want to talk about a little bit last week, but seasonality wise, it's not yet for the natural gas to make a big move. But I want to look at this Bollinger Band. Again, we are like really coiling. So just put it on your watch list. And if you do ETFs, watch the UNG. If you do like the stocks, watch the the natural gas stocks. And basically, this is a major squeeze. So although we just went to oversold, but it is something to consider. All right. Now, the expected move. Now, this was a very even though we had against CPI, PPI, the Fed is talking, the retail, and yet it was just flat. But we started here, we ended up here, right in the middle. It's a doji. We had about 105 or 107 expected move. Now this is a shortened week. We will have about maybe 75. So we just behaved well. The same thing with NASDAQ. We did go upside on Wednesday and then just came back. Really, look at this. I mean, just not much movement. The same thing with Russell. We stayed inside, but it's a little better behavior. But we touched the upper edge and just came down. As far as the Dow, again, I mean, it's like a mirror. We hit the upper edge on Tuesday, came down, and basically with the TLT, the bonds, we did go outside, came back in, and I added this week. So I'm going to be talking more and more about the dollar. So this is the UUP, which is the index for the ETF for the dollar index. And again, we are inside and we behaving well right inside the expected move. When we come to gold, we did go outside 2 days in a row, and finally Friday we actually came back and closed right inside. Silver did the same thing, same behavior. Financials pretty flat, and then energy was a big component which really affected actually. And the reason S&P was negative was energy, big time, almost 2 standard deviation move. So, when you think about Exxons and Chevrons. So that's was one culprit as far as what happened with the even Dow. So, all right. So let's talk about the lesson of the week. I will I'm sorry, emerging markets. This is as of last Wednesday. See, there were the Asian area. There was a lot of selling going on. So, but other than that, Europe, Japan, and US were positive. This is again as of Wednesday. Brazil was down a little bit, but and South Africa. So as a whole, emerging markets were down, but some of these developed European markets were actually positive. A couple of things, talking about Asia and what has happened. On Thursday, the Philippine Central Bank, they actually hiked the rates after inflation surprise. So just pay attention to these things, because we are not just talking about United States. We want to watch what's happening overseas. So in a bid to combat searing price pressure and to manage inflation, now the central banks actually hiked the rates by 50 basis points, and the reason was because the inflation past expectation, and it was at 8.7%. So that means that they wanted to have that rate hike. So, and basically the forecast is pushed up to 6.1% year over year, and that was supposed to be 4.5% when they estimated in December. So that's one. The other news is about, we talked about Indonesia last week, but so the export sector managed to actually outpace expectations, and the outbound shipping rose 16.4% year over year, and it was expectation was 12.5%. So again, largely by oil and gas shipments, and also non-oil exports, 14% to China. So we see that's the China opening is already affecting Japan, 24.9%. And so I thought that's interesting. Again, if you're evaluating from the quantitative side, what is happening with the country, and you can see that the overall trade balance settled at $3.9 billion, although it's the lowest since May 2022, but it was better than expected. So it's all about expectations. Next, again, more of a reference, we want to look at how some of these central banks have been successful. And we talked about some of these even emerging markets. They were ahead of the curve before our Fed even thought about taking inflation seriously. And Brazil was one of them. They started increasing their interest rates. So as far as when you look at the real interest rates, these are just want to give you some ideas. Brazil is at 8%, Oman is at 3.3%, Bahrain is 3.2%, Mexico is 3.1%, Saudi at 2.2%, Vietnam. So these are all positive. India is at 0.8%, and China at 0.7%. And then we come to South Africa. Now we are at 0%. And then Malaysia is negative 1.1. US is negative 1.8. So you still have a catch up to do. And that's the reason there's a thoughts that we need to, short-term rates will go higher. The Eurozone is at 5.5%. And, they've been aggressive. So Iran is at, and that's just officially, it's much worse than this, but it's at 12.4%. And Hungary is at 12.7%. So just want to share that with you. The other thing is we hear a lot about ESG and how the markets want to think about the environment and social, but the governance. And we think, well, we want to make sure, most of people talk about the environment, but the governance is also important. So we want to look at what is happening with the corruption perception index in emerging markets and US. So we could see they were the least corrupted perception of the countries is Singapore, and then it's Hong Kong, Iceland, and US is at 69. And then when you go to the bottom, it's Iraq, Zimbabwe, Nigeria, Lebanon, Iran, Bangladesh, Pakistan, Russia, Egypt, Mexico, Kenya, Ukraine. So let me, I've done a lot of analysis on the corruption, the bribery. So this is the part of the culture. And of course, when we think about, especially from the Western culture, you think about corruption and, it is never good for long-term growth. So what happens is, again, you want to make sure that you know who you're dealing with, what it's written, what the contracts are, they're correct way. We talk about equality, they're treated the same way. Unfortunately, it's not the facts. It's not the way it has been. And you can just take a look at what happened, that unfortunate event in Turkey and Syria, and how much corruption there was. As long as, they're going after the architects and all the engineers, and, they paid the government agencies to approve all these. So there's a complete corruption, and everybody closes their eyes till a disaster like that happens. And yet, I mean, you will see that Turkey will strive, and it will, regardless of all that, that the finding has been, although in the long term, it does make a big difference, again, from the point of view, as I mentioned, the equality and as far as the transparency. But in a short time, even in short years, it really doesn't make much difference. It still goes on. These countries, as long as, again, the flow of funds come and there's opportunities, the money will be there. So, I mean, it's a good news, bad news, but I just want to give you a little, just a heads up as far as, okay, these are the countries as far as the perception of corruption. But that does not mean that the markets are going to go according to this. This is just one element. And unfortunately, as I mentioned, it is not a huge one. As a matter of fact, a lot of people just learn how to deal with it, a lot of investors. So, I mean, last year, remember, Argentina was up over close to 200%, 196%. And, there's corruption. India, there's corruption. So anyway, just thought to share that with you. Another thing is, I've been talking a lot about fintech, because we talk about the future, the ecosystem, and we talked about it is going to play a big role in emerging markets. So whether it's the payments, lending, insurtech, investech, blockchain, fintech, and so as you can see, that the payments are the biggest part of this. You can see with the different countries, or like in Indonesia is the biggest part. They dominate, but it's interesting that in ecosystem they have dropped from 56% to 49%. So the most diversified ecosystem are China and South Africa. The least diversified at this time is Indonesia, Vietnam, and Philippines. So again, food for thought. All right, a few lessons I would say. This is a little chart that I will talk about inflation since 1948. This is what happens when the inflation at this range, what happens at the following 12 months. So basically, only time is if the inflation is at 5 to 6%, we have a negative return. Other than that, when we are here, so when you're at like 6.4%, the markets actually return close to 8%. Obviously, low inflation rate, it's a best environment. We talked about the CPI. So as of January, the Bureau of Labor Statistics, they decided to change the calculations on how the CPI weight will be calculated. And what it was, again, when we talk about, it's a consumer price, that their behavior, what they do, there's the surveys and what they're spending on. So up to this past January, the BLS was looking at the 2-year roll, and they were looking at the 2 years. So starting this year, they decided to say, well, last 12 months are more relevant, because after the COVID, they decided to have that, again, looking at the ideas, what they could do. So obviously, it makes a difference, because again, now we have the 12 months, and we're talking about rolling, and rather than 24 months, which was actually smoothing. So, for instance, as I mentioned, last February, we had a big spike in energy and food. Now that's going to drop. But if we had the 24 months, that would have affected in a more of a, again, we would take the previous months, 12 months, and that would have actually smoothed the effect of it. So this time, I think inflation, just based on over year, it will be it's going to look better, at least till June or so, than what it was supposed to be. It's just a food for thought. How about, how things can change? The other thing is actually the movement of the dollar. I want to, again, I'm using UUP and S&P, and the whole idea is you see how you can use correlation if you want, but I just for the visually, you can see when the dollar goes up, the markets come down. When the dollar goes down, the market usually go up. So that could be another proxy for you to see day to day, if the dollar is strong, is that a good time to be bullish on the stocks or not? So just visually, I want to show you this. Another thing, we're just talking about the dollar and talking about inflation. It was really interesting looking at the Bloomberg's commodity index. This is where we were right around the COVID, and we peaked in the beginning of, obviously, right around the invasion of Ukraine in February of last year. But with all the dollar's weakness and what's happening, we've had weakness in commodity themselves index. So it's very interesting that we haven't had any rebound. So we just broke below the 38.2%. I meant from the low of the COVID era to high of the invasion. And you see that we had just broke 38.2%. So just pay attention to that as far as the commodities go. Talking about commodities, one of the reasons, obviously, is this possible that we are in a super cycle. So the big cycle has started. So although you could see here, granted, we are in a downward, but look at, this is where we used to be. We are still way ahead of where we were. So for the next 8-9 years, that's what's going to happen. So I just want to share with you some of the correlation. So why commodities are important to put it in your portfolio is that they're a diversifier. For instance, they have actually negative correlation with fixed income. They have low correlations to REITs. In the US dollar, you just noticed they generate very big negative towards US dollar. And obviously, natural resources, they are closer, they're good correlation with natural resources. So some of the reasons, this is from the OSPACE, is they come out with the new ETF, and they think the commodities are going to be in a super cycle. And these are some of the reasons. Is underinvestment in supply, government policies, and we've talked about this, especially when it comes to energy. Government policy is not conducive to resource development. Decade of underinvestment in commodity infrastructure. When we talk about generational demand shock, the green transition, decarbonization, ESG, and stakeholder capitalism. And when we talk about further drivers, we look at supply chain complications, labor shortage, unionization, and aging demographics, war between two resources powerhouses like Russia and Ukraine, commodity investments and inflation protection, rising interest rates, reopening of top economic superpower like China, that affects. And on top of that, then we'd see India is surpassing China as #1 commodity consumer. So these are some of the reasons to consider the commodities. The last but not least is, this was an interesting study done on Seeking Alpha, and they were looking at in the past 10 years. So they came up with this model. They are looking at the basket, and they chose their model, their different adjusted ones, the equal ones, and basically the basket. They look at the different factors, and they thought between all these factors, emerging markets should have been up in the past 10 years, 6.7, 8.9, and 8.4. And so basically, these factors going forward, it should have averaged all of these. The emerging markets should have done 8%. And yet, the 10-year return for past 10 years, it's been 1.8. So there is this undervaluation of what has happened of 6.2. On the other hand, US stocks are way ahead of what that, again, this model had projected. They've returned 12.1. So they have been ahead 4.4%. So to make it short, you can see there is the discrepancy. So based on that, it looks like, foreign REITs and real estate and emerging market government bonds and emerging market stocks and foreign investment grade corporate bonds offer a good value. And then they have come up with something called Global Market Index. They have actually used a diversified portfolio, and based on that, they're suggesting that their portfolio is projected and it's very close to that 10-year return. This will be an attractive way of choosing the asset classes. So they're projecting they should have been 5.9, it did 6. So it's about consistency. So I just thought to share that with you. Talking about trade of the week, there's just so many things were happening last week, but I still emphasize again the gap trade, but also the first hour. This is Friday's first hour. As I said, it was pretty choppy, but this was the low of Friday, and this was the high of Friday for 60 minutes. And what did we do? We just chopped around right there. And guess what? At the end of the day, we ended up there. Another thing we've talked about, the strategies. One of the strategies that briefly have mentioned is that 7 o'clock, there's a lot of economic news. Used to come a lot more, but now you usually just watch the 7 a.m. Pacific Coast time for a reversal. So that's, you can put it on your strategies, 7 a.m. strategy, 1 hour strategy bracket, the gap fill. So we have this gap hasn't been filled. We almost filled half of it. On Thursday, we almost filled, well, 3/4 of it. Again, the first hour low, actually, right there, it kind of held. And basically pay attention to these. They can become very handy. This was our Tuesday CPI range. It was a wild ride between, if you would have done, I mean, you could have made money and lose money on both ends. And that, I used ticks, and then 1 minute, it just went down and then went up. So this is a huge range. But you see these two lines have been respected. And see how many times we come and touch this line. And then, as I mentioned, we stayed between. So that was the high of so far what we've had since the CPI. So that kept its high. The low has been violated a few times and gone through. Talking about that, the PPI also provided an opportunity on Thursday. So this is I use a 5-minute bar or candle. You can see how I put the dash lines. Look at this. I mean, it just continued to respect this narrow, really not a big 5-minute, but still it did it. And then once we broke through that, that was it. So we were getting warnings with the DMI right here. We had a bow tie on the moving averages, and then the rest is history. So those are the take. ETFs, quickly, the ARK Next Generation Internet was outperformed all the ETFs by 8.5%. They had Roku and TWO, TWLO. They were up 24.8 and 22.2. As I mentioned, the energy, oil and gas, they didn't have a good week. They were down 6.9%. And other ARK Innovation, they were up also 6%, and PXC was down 6.7%. Briefly, stock of the week. One of the stocks that we discussed on January 6th, 7th class, our session, market analysis, we looked at, that's the reason I think it's important. We look at these moving averages, they have converged so much. I mean, just pretty flat. And that was the GNRC. And at that time, the price was $100.75. We talked about that. Watch for some kind of a movement in that situation. We did have a gap down, so that could have produced, I think, well, this is not clear here. This is a little clear. So we've had a gap down in October, and as you could see, generally the markets like to at least go to the pre-gap. That was our target. First target was 122, and then the next target would have been the support at 136. So this is the time right around here. You see the moving averages. Once we broke above that, the market actually hit the first target, and that was 122. And then it went and almost, it did hit the second target. And now we are just, now that we have closure, now it's getting rejected. But just a food for thought, you know, stocks like this, pay attention to these zones. So, and obviously that worked out well. Here is a very speculative play, I would say. This is like a penny stocks. This is a micro cap. Its only market cap is 100 million. This is a German mRNA type of research diagnostics. Not much volume. You can see on Friday, the volume was like 30,000, no options. But when it moves, I mean, it moves. So if you want to play a little speculation and you're looking at, this is more of, again, diagnostic, medical, I mean, a little biotech in a sense. It has that habit of, you know, basing, and then this on weekly. You can look at on the daily, you'll see the daily is, we've been just basing, and then it has sharp moves with a big spike in the volume. Now, one thing, perhaps we will do a class on penny stock, you really have to be, I would even watch 10 minutes, 5 minutes on these penny stocks to see things like this happen. You know, a lot of news comes out. I mean, you go from $10 all the way to 30, and then within a matter of, you know, sometimes minutes, but like here, it's the next day, somebody bought this stock at 30. And next thing you know, we are looking at $15. So anyway, just put it on your watch list if you want to, looking at it as far as maybe a candidate that could be. These are usually 1 to 3 day trades, basically. And it can be in and out, or you can during the year watch it, because sometimes they have a similar behavior. But anyway, they are right 2% above their 20-day moving average. You can see 50 and 20 is really converging, and then they're below the 200. But anyway, this is very speculative. I just want to share some ideas about these penny stocks and microcap. The last but not least is our squeeze candidates. There's I did it based on market cap, so you will see some familiar names. You know, Monarch Casino is interesting. These are the microcap stocks that you can watch as far as the squeeze goes. Still got some really interesting earnings coming up next week. Nvidia is the big one, but also have the Coinbase, Home Depot, Walmart, Medtronic, Palo Alto. So there's still some plays if you like. These are the more volatile ones. Beyond, for instance. So here's Nvidia, Walmart, Alibaba, Home Depot, Coinbase, Palo Alto, Block, Moderna, Medtronic, and Lucid Group. All right. Okay, thank you so much. I hope it was informative. I hope you all had hopefully it was productive as well. So with that in mind, I'm going to stop the recording. And